righty. It's 4:40 on the East Coast. Thanks for joining us, everyone. I hope everyone's safe who might be impacted by Hurricane Ian. And we've got our thoughts together for all of our friends at the Money Show right there in that vicinity. Everyone's still good up there, though. So we've got Garrett Patton here from Elliott, Elliott Wave Trader, and he's a senior analyst, U.S. equities and U.S. and world indices at the ElliottWaveTrader.net, excuse me. He's a technical analyst and a chief educator at Elliott Wave Trader. It's a live trading room featuring Elliott Wave analysis on market indices and stocks. The articles and analysis from Elliott Wave Trader appear regularly on Seeking Alpha, TheStreet.com, MarketWatch. Mr. Patton's focus is primarily on equity futures and demonstrating the capabilities of unconventional technical analysis. So with that, I'll turn it over to Garrett, but just remember, keep your questions coming in the chat. I will monitor that throughout the session and relay them to Garrett at the end. So take it away, Garrett.
Thank you very much for the introduction. I'm assuming you can still see my screen. I'm sharing it, right?
Screen looks good to me, and I can hear you okay, and I see the slide change. It might take a moment to a little couple second delay to go over the platform.
All right, perfect. Before we get into actual charts, I did want to start the presentation with a brief primer on Elliott Wave theory, since if you are not familiar with that methodology, a lot of what I'll be talking about might be a little bit confusing and unfamiliar. Of course, you don't need to understand it completely, but just kind of a base understanding will help you get a grasp of the analysis that I'm going to be presenting later. So first up, you can see on my screen what is pretty much the basic structure that makes up Elliott Wave theory. That is a 5-wave structure composing of larger degree trends and then a corrective ABC structure, which you see correcting those trends or the counter trend move as price makes its way to the upside, since we all know that markets don't move in a straight line. So the reason that we have a 5-wave structure followed by a 3-wave structure to create those larger trends and corrections is basically to allow for both advancement as well as fluctuation, and that 5-wave structure can progress more ground than the subsequent 3-wave structure that corrects that larger degree trend. So basically, again, that 5-wave structure to the upside and that 3-wave pullback is the basis for all the larger degree counts that you see Elliott Wave analysis or analysts present to you. If you've ever seen them out on the internet anywhere, or you've dabbled in Elliott Wave theory yourself, you're probably familiar with all of this. And another important note to make is that the overall structure of the market is fractal in nature within our expectation, approaching it from an Elliott Wave perspective. So that basically means that these 5-wave structures to the upside followed by 3-wave corrections build upon each other in order to create larger degree 5-wave structures and larger degree corrections. So if we were to zoom in and examine the structure of this wave 1, it should also take shape as a 5-wave move, and then that 3-wave pullback is the wave 2, the correction of that trend to the upside as an initial wave 1. And we could zoom even out further than this, and this 5-wave structure to the upside could itself be a larger wave 1, and this pullback is a wave 2 to create a bigger, larger 5-wave move from that one to start. So again, fractal in nature, which means that the same price patterns that you're seeing on daily charts, on weekly charts, on monthly charts are the same as what you're seeing on those smaller time frame, hourly charts or 3-minute charts or even tick charts. Another important component of Elliott Wave analysis is something that we refer to at Elliott Wave Trader as Fibonacci pinball. And this is what actually makes Elliott Wave analysis reliably tradable. And the premise here is that the subwave structure, that fractal nature of markets, the subwave should exhibit some sort of Fibonacci relationship to each other based on their overall side, the amount of price that price covered, or the amount of price covered by that specific wave. So the size of wave 1 compared to the size of wave 3, for example, is what we're looking at here. And the fibs that you see shown on the chart here are based on the size of that wave 1 projected from the bottom of the wave 2 to give us those fibs to the upside. And although these are a guideline, you're not going to see every single impulsive structure within the market take shape the same way, but these fibs that you see the individual subwaves hit as they fill out that larger 5-wave move, more often than not, tend to target the same specific fib levels, which give us, tradable targets when we're dealing with an impulsive structure and a trending move to the upside or downside, which, as we all know, we want to trade with trend in the broader market. So what we often tend to see is that based on the size of that 1-2 in the initial start to a 5-wave move to an impulse, the wave 3 of 3 tends to target the 100% to the 1, 2, 3, 6 fib. If the wave 3 stops at the 100%, then the most common target for the wave 5 of 3 is the 1382 fib. Then you typically see a pullback to about the 100 to 764. And if the wave 3 stopped at the 1382 fib, then the 5th wave tends to target the 1764. Now, again, these are just kind of guidelines as far as expected targets when you're starting off that initial wave 3 and you have a 1-2 in place and you're trying to trade that move to the upside. Obviously, as I said, not every single impulsive structure is going to follow those exact fibs, but more often than not, they tend to turn it around those levels. And if you do see an extension within a specific subwave, all you have to do is just compensate by moving the rest of the subwave targets up the same relative amount. So let's say the wave 3 of 3, instead of stopping at the 100%, hit the 1, 2, 3, 6. Then rather than stopping at the 1382 for the wave 5 of 3, we would expect 1 fib higher there as well to the 1618 and 1 fib higher for the wave 5 up to the 200% as well. Another, I think, important thing to talk about just regarding what we're going to be discussing later when we look at the actual S&P 500 is something called the guideline of alternation. And the premise behind that is basically that within those 5-wave structures, those impulsive moves, we tend to see a different character of correction within those 2 corrective portions of the 5-wave structure, that wave 2 and the wave 4. So if you have a shorter lived quick correction, a sharp correction is the wave 2, more often than not, you're going to see a longer drawn out correction for the 4th wave. And sometimes you do see the opposite. You see a much, more drawn out wave 2 and a quicker and smaller wave 4. But this is more standard, is that shorter lived, sharper wave 2 correction than a much more drawn out 4th wave correction. So again, this is just all for context when we look at the actual charts later. And those 5-wave structures that progress price in the direction of the larger trend come in 2 different varieties. They can be impulsive,
Garrett,
which, yes?
Hang on a second. I think there's a technical issue going on.
What's happening?
I'm seeing some people can't hear or can't see it, but maybe just want to make sure that we're not having some issues with what's going on down there. So just hang on a second.
Yep, no problem.
I know you're on a roll there. Let's just see. Can you hear us out there, people in the chat? I know Eric was saying he can't. Okay. No issues there. Maybe Eric just needed to refresh. Go ahead, Garrett. Pick up where you left off. Sorry.
Okay. So again, 2 varieties of those 5-wave structures. One is an impulse, and those are the most desirable to trade. They're the strongest portion of the larger trend when you see price make the most progress in the shortest amount of time. So this wave 3 especially is the most desirable portion of a 5-wave structure to trade. But the other variety is a diagonal structure, and it still produces that 5-wave movement. It still progresses price in the direction of the larger trend, but in a much more labored fashion, and typically with overlap between the 4th wave and the wave 1, the 4th wave dipping into the wave 1 price territory. But that's not a rule. It's not required. And as the names, as you can see, suggest, those diagonals come in 2 varieties: a leading diagonal, which would be at the either beginning of a 5-wave structure or the beginning of a correction. So it can come in either a wave 1 position or an A wave position, or an ending diagonal, as the name suggests, at the end of either that 5-wave move or the corrective ABC. So either the 5th wave position or the C wave position. All right, now that we got that out of the way, let's take a look at an actual chart. So you should see pulled up on my screen a 3-month chart of the S&P 500. So each small little bar, it's kind of Difficult to see them individually, but they represent 3 months of time. So this is going all the way back even prior to when the S&P 500 was created. So some of this is actually borrowed from some of those previous larger companies that were trading publicly prior to the S&P 500. Adapted data, it's from Global Finance. And you can see, hopefully you can start to see what I mean by that five-wave structure within that larger trending move to the upside. And just a little bit of history prior to the start of the larger bull market that you can see going all the way back to the Civil War in 1855. Early 1800s was a chaotic time period for the US and the rest of the world. Overall, it was a period of worsening sentiment and social mood. Europe was entangled in the Napoleonic Wars and had been at war practically the entire century prior. The US was still emerging from the Revolutionary War and even declared war again on the British in 1812. The Industrial Revolution was in full swing, and people were starting to transition from rural to urban living, which caused further rift between the North and the South. Westward expansion began after the Louisiana Purchase, which led to numerous wars with indigenous tribes. Territories were being drawn and states were being formed, which led to further conflicts such as the Mexican-American War. And tensions between the Union and the Confederate South ultimately culminated in the Civil War between 1860 and 1869, which marked a turning point in sentiment at the time and was the lowest point of our economic history. You can see that was where the bottom was formed right before that Civil War started. From there, things started to slowly improve and the stock market began to make progress higher, albeit in a labored and choppy fashion, as a leading diagonal structure, which is why I wanted to go over a couple of those structures before actually getting into the individual charts. So you can see that initial, what is referred to as a super cycle degree wave one, within the start to this larger bull market began with that leading diagonal. And there was still a major conflict during the fourth wave of that leading diagonal, which was World War I, but it led to the first euphoric phase in our markets that they had experienced, which was the period during the roaring 20s when we saw that sharp move to the upside to conclude the leading diagonal before the Wall Street crash of 1929. And after turning parabolic until that top, it snapped back just as violently in what is still the worst crash in our history of our markets, resulting in the Great Depression. The economic destruction at the time was worldwide, and it set the stage for World War II. It was also at this time that the man who discovered Elliott wave principle, Ralph Nelson Elliott, forecasted a multi-decade bull market that he believed would culminate in 2012, which, if you ask me, is one of the most impressive prescient calls that I've seen from any analyst. Obviously, there's some great calls out there, but all the way back at that time when things, in the heart of World War II, when the world was basically falling apart, to say that we're about to rally for the next 100 years to the upside, which did turn out to be the case, is pretty impressive. And it's because he was looking at that structure, that five-wave move to the upside going back to the Civil War, as that supercycle wave one, the correction which held a higher low into the Great Depression as the supercycle wave two, and then what looked like the initial one to start forming within that larger supercycle wave three. So fast forward past all of that move to the upside since into present time. And you can see we are approaching and potentially have already struck the next larger degree top as that supercycle wave three within that five-wave structure, going back to the low that was made before the Civil War. So within that expectation, if we've completed that supercycle wave three and are now starting the next phase within that five-wave structure based on Elliott wave principle as a fourth wave, we're looking at a correction that should be at the same degree as the Great Depression. So that sounds pretty ominous, but one of the reasons why I wanted to show you that chart of alternation, when we tend to see a very sharp and quick structured correction for wave two, we more often than not, we'll see a more drawn out correction for the fourth wave. The downside to this is what was a relatively short-lived correction of only about, I think it was about 9 or 10 years for the supercycle wave 2. We could be mired in this fourth wave correction for potentially several decades if we're going to see that alternation of time as far as how long that correction takes shape. But because it was that quick, sharp correction to the downside as the super cycle wave 2, that means we should see a more drawn out flat structure for the super cycle wave 4, which does give price the opportunity after completing the initial decline as the A wave to potentially at least see a very large rally as a B wave, which could even make a new all-time high. If you're familiar with Elliott wave theory, an expanded flat structure, the B wave within that correction can actually exceed where the previous impulsive wave topped before turning back down in the C wave of that wider flat. So we could even get new all-time highs within that correction before that final drop as the C wave to complete the supercycle wave 4. Before starting the next higher degree supercycle wave 5, which should last, obviously several decades more before the entire 5-wave structure going back to the Civil War completes. So I'm going to shift gears here real quick to some live charts. Actually, even before getting into the RSP, let's take a look at the S&P 500. I wanted to show you the correction between 2018 and 2020 is what would be primary wave 4 within the cycle wave 5, going back to the 2009 low. So again, you should see pretty clearly that 5-wave structure that I'm talking about as far as what we see for trending moves within the market off of that 2009 low, which is where the next or the previous larger degree correction as cycle degree wave 4 has completed, with a pretty clear 5 waves to the upside into the high that was made at the beginning of this year. And if you'll notice, it might be a little bit difficult to see, but these fibs here, I can change colors so they're maybe a little bit more visible. Again, when I was talking about that Fibonacci pinball, how we take the measurement, the size of that wave 1, project it from the bottom of wave 2 with our Fib expansion tool, we get some standard targets to look for as far as how the rest of the subwaves of that 5-wave structure will fill out. So we see that the wave 3 hit the 100% Fib, as I mentioned, is a common target for the top of a wave 3. And when we see the 100% reached for the wave 3 of 3, typically the 1382 Fib will be reached for the wave 5 of 3. That's where we saw that 2018 high. And then we got an expanded flat. So this is kind of what I see as a potential scenario for the supercycle wave 4, where we get a decent sized correction as the initial A wave, but potentially the B wave can make a new all-time high. And in the case of the expanded flat that we saw between 2018 and 2020, that higher high was actually pretty significantly beyond the previous high that was made in 2020, even though it was a B wave within that wider flat correction. So it's not all doom and gloom, but unfortunately, if we did complete the supercycle wave 3, I don't think we're anywhere close to completing what will be the cycle degree A wave within that supercycle wave 4 yet.
Dave, I'm sorry. The Money Show support is helping one of the people view this. Thought it was a question for you.
Oh, okay.
About making the resolution a little bit better. Go on.
So again, there's the potential for that 5-wave structure off the 2009 low to complete. And within that larger degree count that I was showing, that can be, that's why I was afraid of actually clicking that there. Go back to this. That 5-wave structure, zooming back out to that 3-month chart, you can see, would be the cycle degree 5th wave within that super cycle wave 3. Unfortunately, my charting software froze. So while I'm reloading that, is there maybe an initial question that I could answer?
Yeah, there's a few good questions. I mean, these charts are fascinating. I think it's just a little hard for people to see, but they can see these slides on the replay if they want to look further. And if you
And on the pinned post on my Twitter is actually that 3-month chart if you want to.
Oh, that's cool. And then you could just refresh your browser. It might make it look better. So let me go back and get some of these questions. From Matt, how do you ignore the peaks and valleys between 2 and 3? I guess he says for counting.
You're not ignoring the peaks and valleys. As I mentioned at the beginning of the webinar, the approach of Elliott wave theory is that markets are fractal in nature, so that larger 5-wave structure, the subwaves within it, so wave 3, for example, itself should subdivide into a 5-wave structure as well. So you can, assuming the slide is still up here, that primary 1 and 2, primary 3 and 4, and then a 5th wave to get a 5-wave structure within the cycle wave 3 up into the high that was struck in 2000 at the top of the tech bubble.
I just want to ask myself for a little clarity. Where exactly are we right now? Are we at the top of super cycle 3?
Yeah, we're right here. This is
I know, but what it's a 5 on the mini cycle, right?
Yeah, so again, I was hoping that little primer at the beginning would make it a little less confusing, but again, the different labels you see here are just representing those different degrees. Again, that fractal nature of the market. So
right,
this Roman numeral 5 here is the 5th wave within the structure that started off of that Great Depression low. So this is a cycle 1, 2, 3, 4, and then 5th complete. And then from the 2009 low, which completed that cycle wave 4, smaller primary degree 5 waves up within that cycle degree wave 5. And then that's within the super cycle wave 3 going all the way back to the low before the Civil War.
So this says we're going to make a lower low sometime next year.
I really was hoping that my software wouldn't cause issues for me. It tends to, unfortunately, do that when I try to pull up this larger degree chart. And I have to go back to a backup copy, which is I'm not going to be able to do. So unfortunately, we're going to have to stick with this chart for the time being. Instead of looking at some other charts, it doesn't necessarily obviously have to be a straight line to the downside. And before the past couple of weeks here, the trading that we've seen over the past couple of weeks, you have to submit the description and the title of these presentations at least a month in advance. So that's why it was called One Last Hurrah, because my stance was as long as we were holding above the June low, then there was still potential to see one more higher high within this primary wave 5 next year before the cycle degree 5th of the super cycle wave 3 completed. Now, obviously, over the past week, we've seen this week we saw a marginal break below that June low. So I do have to approach that expectation for another high within that cycle degree wave 5 as less reliable. It's not completely out of the question. And one of the things I was going to go over is some individual sectors within the market that do still look reasonably positioned to attempt that higher high. Again, unfortunately, I won't be able to show you the charts, but those sectors are, I think the most confident right now is going to be energy stocks. So XLE and XOP and natural gas stocks as well, if you trade FCG. Those ETFs do look positioned after this current correction off of the June high completes, which I think we can revisit the lows made in July 1st. Before setting up that higher high next year. So energy and a lot of different commodity related charts, I think, are better positioned to attempt higher highs, which could foretell that we're not completely peaked with inflation yet. And that could be the reason why we continue to see other equities decline further in the start to this super cycle wave 4, because the Fed continues to hike at a pace that we haven't seen in quite a while. Some other sectors, though, that do look like they can be positioned for higher highs next year. XLV is still holding above its respective June low. even a break below there doesn't necessarily invalidate the potential for a higher high, but I would view it at that point as reduced probability. So as far as the best odds of seeing a higher high in healthcare stocks, holding above that June low would certainly be ideal. XLP as well, consumer discretionary ETF, Spider ETF, is another area of the market. And you can kind of see a theme here as far as more somewhat defensive or more recession-proof stocks being able to still see some further upside before we see a top in those specific sectors, and XLU as well, utilities, especially also holding above the June low, I think can still attempt a higher high. Areas of the market.
A couple more questions.
Sure.
How successful is your approach to predicting the overall market?
Well, a good, I think, barometer as far as our success rate. My colleague Zach Manis and I, we every earnings season go through the major companies reporting and kind of try to call which direction they will be moving after their earning report based on our Elliott wave count, and we typically get about 70% of them right. So that's
pretty good.
That's usually what I say, about 70%.
Gary is saying, so Avi is now saying January was the top. That's new news as far as I'm aware. That's a capital V.
Right. And that's my stance on that changed this week when we undercut the June low. That was yesterday, right?
So that means that we haven't seen the super cycle wave top.
I have to view it as a less reliable and lower probability expectation. And we certainly have to respect the possibility that we did already put that top in place.
And that's the V that's not in the parentheses.
Well, it would be all three of these labels topped. So starting this super cycle wave 4.
Okay. So the parentheses is the longer term cycle, right? It's on top. Okay.
Yes.
It was clear in the beginning, but some of us who aren't super familiar need to be reminded a little bit. So thank you for that. Question, what charting software are you using?
Motive Wave is the
Motive Wave.
Yes. Motivewave.com if you want.
And then we have, so are you saying the odds are we go down further from here? If so, what level is most likely?
It does, again, doesn't have to be a direct line to the downside, a straight move to the downside. There's certainly the opportunity for a relief bounce going into the end of the year, which again doesn't necessarily need to make a new all-time high, although those sectors that I mentioned can be positioned to attempt higher highs next year. And I'm not completely ruling out the possibility of a higher high in indexes like the S&P 500 as well. I just have to view it as less probable than it could have been had price held above that June low. Really, the most immediately bearish thing that I would consider right now is a trip down to about 3,300, 3,200 before the next B wave bounce.
That's S&P, right?
Yes.
Yeah.
S&P.
EWT previously indicated that the top of wave 3 was yet to come above the high in January. Did that change? I guess you just answered that, right?
Well, we had always been looking at the January high as a third wave within this this circle wave 5 here. It was just a question of, were we holding a fourth wave to get one more higher high as a fifth? Again, that fractal nature. So this circle wave 5 itself should subdivide as 5 waves within that move off the 2020 low. The fibs were supportive of a top in place. The subwave structure wasn't as much. So that's why we were looking for evidence that we were going to get one more fourth and fifth. From a probability standpoint, for me, that was dependent on holding the June low. Since that broke, again, that's kind of changed the probabilities for me.
Similar question, but I think it's worded well. How low do we go from here until the start of a new bull market? I think you were saying about 3,300 is the potential low.
That in that scenario, that would just be an A wave, though, within this larger degree A wave. So we could get a bounce from there, but not heading to new all-time high, just a bear market rally before setting up for the downside. Just a rough estimate. This is by no means written in stone, and reserve the right to change that opinion as the price structure fills out. But heading back to the 2020 low for this cycle degree A wave before the B wave bounce, but again, expecting that to be corrective, and then a C wave, which could take us even deeper than that, maybe back to the prior highs that were seen in 2000 and 2007 before the super cycle wave 4 completes. And again, based on alternation, if that supercycle wave 2 is a very quick, sharp correction, much more drawn out, potentially multi-decade correction for the supercycle wave 4 with a lot of whipsaw back and forth.
Another question. I mean, I have my own questions, but I'm going to hold off. I am confused. Are we still headed to 5,100 after this correction or not? Is the bottom still in the 3,400 region?
Same comment. It's still technically it's a possibility, but I view it as a less reliable, lower probability expectation now.
What is the target for a current wave down?
Again, most immediately bearish that I see is continuing from here down to 3,300 to 3,200 before getting a bear market rally. But again, that's not the only possibility. There's even the chance that we from here head back up to the August high, don't make a higher new all-time high, retest that August high, and then turn down again.
In the past, I believe the market would likely move north of 5,000. You've addressed that. Current wave down, you addressed. What about GLD as a sector?
GLD, the correction from 2020, still has the potential to be completing even potentially at the overnight low. We saw a really nice move from precious metals off of that overnight low today. Obviously, more confirmation of the bottom is still needed, but the potential for corrective pullback in gold from that 2020 high to set up another higher high beyond there is still intact as far as a reasonable potential right now.
Can NDX make a new high next year?
The Nasdaq's a little bit different than the S&P 500 because the low for the same cycle degree wave 4 correction was actually back in 2002. The low that was made in 2000 and I think it was 8 in the case of the Nasdaq held a higher low. So there's potentially a extra 1-2 there within the cycle degree wave 5 going back to that 2002 low. So this could just be completing the third of that cycle wave 5, meaning we could see a fourth and a fifth to new all-time highs in that case. So there's a little bit of a difference in the NASDAQ compared to the S&P.
Is it too early to buy TLT?
Just know that you're buying without a confirmed bottom. It's at a spot where a bottom looks reasonably probable to be attempted. And again, we saw a really nice reversal today that has certainly opened the door to a bottom being attempted. But as far as, some evidence of that, getting some higher highs, higher lows, taking out some resistance, hasn't done that yet. So a little bit early as far as confirmation of the bottom.
What wave count do you see for the US 10-year Treasury right now?
I mean, same as TLT, just inverse. It looks like a top in place is being attempted here. The move up from the 2020 low as far as yields go to set up a decent sized multi-month reversal, but we need more confirmation of that still.
Where is the B bounce new high?
This B wave. So yeah, when I mentioned that because of alternation, that very quick sharp correction for the super cycle wave 2, that we could expect more drawn out flat structure for the super cycle wave 4, and there is a variety of corrective flats where the B wave can make a new all-time high. So that is a possibility, but again, we're not anywhere close, if we have completed the super cycle wave 3, anywhere close to finishing the initial A wave first before possibly setting up a B wave to new all-time highs before the C wave back down.
What would it take to make you think that the third wave did not top out yet?
First, getting back to the August high in what looks like ideally 5 waves up from wherever we put in that bottom, and then holding a corrective pullback from there, another higher low, taking out the high of that 5 waves up would open the door more confidently to possibly seeing a new all-time high again.
Matt says my questions maybe I might ask you something at the end here. After the next bottom, what's the parenthesis for? Is that super cycle? No, which one's that? When it's in
This
the
one, the parenthesis Roman numeral, that's super cycle. Yes.
yeah. After the next super cycle 4, what does super cycle 5 look like?
It should be a 5-wave structure. Since it is a 5th wave, meaning it's at the end of the impulsive 5-wave move, it can take shape as a diagonal. We were looking at those 2 different varieties of 5-wave structures at the beginning of the webinar, an impulse and a diagonal. So it should take shape as 5 waves, but either as an impulse or a diagonal. And obviously that's not something I can predict yet.
What's your view on the US dollar?
US dollar should be completing 5 waves up off the 2008 low very, very soon. There's room for a little bit higher. I don't think we have a confirmed top in place, but that 5 waves up I'm viewing as a larger cycle degree wave 1, which means we can spend several years correcting in the cycle degree wave 2, but holding a higher low compared to the 2008 low, and then make new all-time highs in the dollar.
Just to clarify, while we're looking here, these major lines here are 10-year, they're decades, right?
Yeah, you can barely even see each individual
right. So
line, but
if somebody's asking, about that, based on your view, we will have a further downtrend lower than the last low in June by the end of this year. I'm not sure that that's what the charts say.
Well, I mean, we yesterday even already made a lower low compared to the June low.
Right. What happens after, this is why it made me ask that. Hold on. What happens after the super cycle wave 5? That wave 5 looks like it's out in the year 2083 or something.
Yeah, 2093. So I'm not sure many of us will still be here.
Yeah.
That can complete a even large degree, either wave 1 or maybe potentially a 3rd wave. Again, as far as the US markets go, I'm counting the start to this count to that low prior to the Civil War. Obviously, there are other markets that were trading earlier than that, European markets, where this could be a 4th wave bottom. And so the structure since has been a 5th wave, or it could be a 3rd wave, basically completing another 5-wave structure to the upside and setting up the next higher degree correction, which would be an even higher degree than the correction that we're talking about right here for this wave 4, which means that could be, even a century long potentially.
From the chart, it seems the market could reach the 2008 lows in 2033. Is that true?
As far as an estimate for the bottom, again, I'm looking at a retest of the highs from back in 2000, 2007 as a possible target to reach before the cycle degree wave 4.
Not the lows,
completes.
the tops.
Yes, the tops.
Yeah, the top in 07 before the low in 08. Right.
Yes.
And
as far as where that intersects with the trend channel, you can see drawn on the chart, that's probably in the around 2040
so
region.
We're coming up on 8 minutes late, and somebody's asking about other factors with the Elliott wave analysis, like inflation, recession, interest rate hikes. I'm not sure that any of that is in Elliott wave as far as I know, but I'm wondering about the time compression as society matures and things happen faster. If some of these decades can now become years or less than decades, and also the channel that goes from the beginning of this chart through ahead of the 20s is a pretty horizontal channel, and since the Great Depression it's more of a 45-degree angle. So I'm just wondering if there's some time compression and change in things when you had the systemic changes to the world and the market after the Depression.
Yeah,
the
that's
internet
a
and all of the modernization stuff and other things out there.
So Elliott wave theory is based purely on price. There's not really any sort of timing component built into the analysis method, only really just looking at the relative size of waves compared to each other to, are they proportional to what we typically expect as far as what's standard. So there's certainly the potential that these cycle degree wave 4 completes much sooner, and it doesn't stretch out for several decades. That expectation is just based on, again, that guideline of alternation, when we typically tend to see after a very quick sharp wave 2, a more drawn out as far as timing goes, wave 4. But as mentioned, it should be very choppy. So what I'm calling a correction during the entire move isn't necessarily going to be what pundits in the media are calling a correction the entire time. You know, if we drop back down to the 2020 lows and then make a new all-time high after that, everybody is going to be referring to that as a bull market, right? So again, it's not that we're heading straight down for the next several decades. It's going to be a lot of back and forth.
Well, I hate to stop this because I could go on for a while and discuss this with you. And a lot of these people are asking a lot of questions. So I think you should email Garrett for more, get the slides, look at it further. Do you have an email address you want to use, or just send them to your website?
Yeah, before concluding, we at ElliottWaveTrader.net, that's the website that I'm an analyst at. We offer a free 14-day trial with no credit card required. So sign up for a trial, shoot me a DM. I'd be happy to answer any questions, and you can take a look at a lot of these charts in more detail, as well as unfortunately the ones that I didn't get to go over as far as those individual sectors.
Well, I'm just happy we were able to get this off with our Money Show friends being bombarded by Hurricane Ian, and I hope anyone is involved with Ian is safe and staying safe and being smart about things. It looks pretty nasty down there from what I've seen on the news. And will I see you in Orlando, Garrett?
Not this year, no.
Well, hopefully some people will be down there, because I'm going to go, and I'm looking to do some in-person chatting with people. But great presentation, Garrett. Appreciate your time. And we're going to leave it there.
All right. Thank you very much. Take care, everyone.
Thanks, everybody. Have a great day and stay safe.